Welcome to another video. If you are new on Xtrade channel, please consider subscribing to the channel, hit the like button and also feel free to leave a comment down below. In today's video we will talk about terms used by traders in Forex market. There are many terms used by traders that can at times make it seem like the market has a language of its own, and these can be confusing when starting out. Knowing and understanding the proper terminology within the Forex market is essential in becoming a successful trader. In this video you will learn what pips, lots, margin, leverage bids, offers and spreads are. Pips and lots. Currency traders quote the value of a currency pair and trade sizes in pips and lots. A pip is usually the smallest amount by which the value of a currency pair can change, although these days some brokers offer fractional pip quotes too. In example, when the value of the euro to US dollar pair goes up by 1 tick, i.e. pip, the quote will move from 1.2345 to 1.2346, and the size of the movement is just 1 pip. An important guideline for the beginning trader is to measure success or loss in an account by pips instead of their actual dollar value. A 1 pip gain in a $10 account is equal, in terms of the trader's skill, to a 1 pip gain in a $1,000 account, although their actual dollar amount is very different. When it comes to actual trade orders, the spot Forex market is traded in lots. Lots come in a variety of sizes including standard, mini, micro, and nano, which are each made up of different amounts of currency units. Lots work using the principles of leverage that we have already discussed. They simply structure the specific amounts that can be applied to each trade. Each lot is constructed from currency units, which simply translates into real-term values. Therefore, a standard lot consisting of 100,000 units can be equivalent to a controlling monetary value of $100,000, etc. The smallest size in currency trading for professional traders is called a lot. For USD-based pairs, the lot size is 100,000. In other words, when you enter a trade with your margin account, the smallest amount that you can buy or sell is 100K, regardless of the size of your margin. Leverage. Leverage is the double-edged sword of Forex trading. Whilst on the one hand it provides retail traders with the chance to make substantial profits from the currency markets, by exploiting only relatively small movements in currency prices, it can equally lead to situations where losses, if unchecked, can far exceed original investments. Knowing the implications of leverage, how it works, and how it can be used effectively will, over time, prove to be extremely beneficial. This means learning to manage leverage in a manner that will give the best possible chance of making profits, but at the same time reducing the risks and possibilities of accumulating losses. Leverage, by definition, is the instrument that allows a trader to borrow and control much larger amounts of collateral, using only relatively small personal investment. Traders can enter transactions using this personal investment, that when leveraged is multiplied to give control of a much larger stake of currency. This means that profits can be made from relatively small currency price movements. The important lesson to remember is that leverage works in both directions. Therefore, in the same way that leverage will increase the value of any profits, it can also rapidly multiply any losses. In practice, leverage will be used every time that you execute a transaction order. When entering an order, you will be required to select the level of leverage that you wish to apply to that transaction, and this will determine the amount of currency that you ultimately control. The amount of money that you personally have to put towards the transaction is known as the margin. This amount will have to be available within your account before a broker will execute the trade on your behalf. An example of leverage in action. Imagine that you have $1,000 that you wish to invest in a particular currency pair and you decide to enter a buy transaction, also known as going long. As you place your order, the broker will give you a variety of leverage options, depending upon the type of account you hold. For this example, we can use a leverage level of 100:1. This means that your investment of $1,000 is multiplied by 100, giving you control of $100,000 of currency. It is that level of currency that is then applied to the trade, and you enter the market theoretically holding that amount to invest. If when you close the trade you have judged correctly and the price of the currency has increased over the period, then that price rise is applied to the $100,000 rather than your margin amount of $1,000, thus considerably increasing the level of profit accumulated. Margins. As previously mentioned in connection with leverage, it is not necessary to have an account actually funded with $100,000 in order to control a lot of currency with that equivalent value. Instead, following their application of leverage, a broker simply requires you to have a percentage or deposit on account, to which this leverage will be applied when you trade. This percentage or deposit is what is known as their account margin. The value of this deposit will depend on the type of account held, the specific requirements of your broker, and your individual preference. In the case of a trade using leverage of 100:1, then the account margin required would be a minimum of 1%. So if you wish to execute an order for a standard lot, $100,000, at 100:1, then you would be required to have a minimum of $1,000 as a margin in order to proceed. Brokers will often require their account to be sufficiently funded above their account margin so that any surplus amount can be available to fund possible losses. Bids, offers and spreads. When dealing with the pricing of currency in the spot forex market, there will always be two prices at any one time for every currency pair. These two prices are known as the bid and offer price, and the difference between them is known as the spread. It is important to understand the difference between these two values, as they are a vital element of all trading strategy. The bid price will be the price quoted at which you can sell currency, and the offer ask is the price you will be quoted when you wish to purchase currency. The bid price will always be lower than the offer ask price, and it is this spread between the two prices which allows brokers and market makers to profit from transactions. Long and short positions. One of the most attractive features of the forex market is their opportunity to make profits whether prices go up or down. This means that, as a trader, it is possible to accumulate pips irrespective of whether they come from upward or downward trends, greatly increasing the potential returns available and providing considerable flexibility for developing trading strategy. When a trade is made, the term used to describe this is known as taking a position. If the trade is based on a transaction where the trader is predicting that the price of a currency will increase over the duration, then this is known as a long position or going long. Conversely, when the trader makes a transaction whereby they are predicting that the price will decrease over the duration of the trade, then this is known as a short position or going short. Thanks for watching, hope you guys have enjoyed the video, and please don't forget to like and subscribe to the channel. I'll see you in the next video.